There's 124 trillion that's moving downstream from the baby boomers to the next gen in the next 20 years. In order to have a family office, 250 million is a bare bones minimum, 500 if you're going to invest in the direct deals. Only 25% of families make it to the second generation, 10 make it to the third, 5 make it to the fourth. Today, the way most family offices are structured, the people they have on their team, they're going to be mostly better off investing in funds and not investing directly. There's currently $10 trillion in capital in family offices, and patient capital is the single biggest advantage family offices have. So I learned the importance of working with an estate planning attorney. And I think that's probably the single most valuable person that these family offices work for. It's not the CIO. So it's a really new industry, but it's also very fragmented. It's very siloed.
Ronald, great to have you on my podcast. And this is the first episode about family offices.
Wonderful to be here. Thank you for having me.
Yeah. Yesterday, I figured out that we have 2,000 mutual connections on LinkedIn. So a lot of audience is both connected with family office world and with venture studio world. And I know that prior to going into the family office world, you started a hedge fund which outperformed the S&P 500 index for 10 consecutive years. Then I know that you launched a syndicate of family offices, like a multi-family office of 100 family offices investing in different deals together. So this is like probably one of the biggest family offices or like community of family offices investing together. Then yesterday, congrats with this announcement on becoming an editor-in-chief of the National Law Review's first newsletter dedicated exclusively to family offices. And when I think about family offices, the first name appears in my mind is yours. So I'm very inspired to talk to you today. Also very grateful that you attended two of our virtual conferences and spoke about family offices there. So my first question will be, what is your path towards becoming top figure in the family office world, and like when and what happened when you understood that you want to specialize in family offices?
Well, so it's a bit serendipitous. It wasn't like a masterly crafted plan. I graduated from Northwestern and I got a job at Drexel Burnham, and Drexel was at the time the most profitable firm on Wall Street. And I was there for 2 years and Drexel imploded. It went bankrupt. So I remember very vividly the scene of when Fred Joseph, the CEO, announced that we're going bankrupt. I'm in the room with people in their 60s and 70s, and men didn't typically cry in the late 80s or early 90s. They certainly did there, because many of them lost most or all of their money. And my takeaway, so my plan was really just to go to work at Drexel and hopefully, if it worked out well, run a division one day or run a company one day. That didn't work out after 2 years, and I was a bit disillusioned. So I moved back to Chicago and I started a hedge fund without really knowing what I was doing, which I think is probably true with a lot of entrepreneurs when they first get started. But I was very disillusioned. And I just started with a couple $1 million and from friends and family, and I scaled it. And I grew it to about $300 million. And we ran it for about 10 years. We had some pretty good tailwinds behind us. So there was certainly an element of luck to it. And we did outperform we never had huge returns, but we outperformed the S&P 10 out of 10 years. And then I thought the market was overvalued, so I sold my company to a market neutral firm, which would do well in a market that goes up or down. We were just good in an up market, and stayed on board, kept 100% of the assets on board, and then got my liquidity and then started investing. And what I did and what I do is I put together a syndicate of family offices. So we've got about 120 family offices. These are families anywhere between 250 million to 30 billion, and we invest together collectively in the private markets. That's private equity, venture capital, real estate, credit. We don't charge anything, but I'm not doing it for self-less purpose. I do it selfishly because I don't have enough capital to put $100 million per deal. Now I do. So I call what I do first call alpha. And the reason I got into this space is because basically the numbers, I look at things, I'm an economist by trade, and I look at things from a macro standpoint. There's currently $10 trillion in capital in family offices. there's 124 trillion that's moving downstream from the baby boomers to the next gen in the next 20 years. So we're about to experience the largest transfer of wealth in history. So those two factors really made me realize this is a market I want to be in.
We've published several research papers and reports on family offices, VC, venture studios, and AI. You can find the links in the description and download them for free. We are now looking for family offices and venture studios to participate in our new 2025 study. Find the information in the description. So about your hedge fund, was it at the end like 250 million or something?
We grew it to about a little under $300 million. Yeah, we scaled it and it did quite well. But then when I sold it, this is when I put together a syndicate of families because I call it first call alpha. I wanted to, I didn't want to get a call after 30 people have said no and then I get to see a deal. I wanted to be the first call. But I don't have enough capital to be the first call. Yeah. Now I do.
So you mentioned earlier 1.2 billion AUM. Is it like the total number of deals you did with your syndicate, or like what is this number?
I don't know the exact number we did. I mean, we probably do about a dozen deals a year. We typically do direct deals. We have invested in funds if we have to in order to get access to the direct deals, but typically we invest in direct deals. And I'll put in some money, I'll aggregate some money. And with my consortium of families, if there's 100 families, 120 families, I know who likes what. So if it's a real estate deal, there might be 70 families that might like multifamily real estate. If it's early stage venture, there might be 7. If it's healthcare, there might be 24. So I kind of know who likes what, and I come to them, and as long as they're liquid, they'll typically invest alongside me. You
first have to give to family offices, then only you might ask something. And so this is your way to do it, or like I'm impressed that you don't charge any fees on those deals. So you actually like just sharing deals.
Right, but again, I'm not doing this for selfless purpose. It is selfish because even though I'm not charging, and I could charge, short term, this makes no sense. Medium term, it makes sense. Long term, it makes a ton of sense because I'm completely aligned with everybody. And I realized very early when I worked at Drexel that if Google is going to go public and you've got 1,000 shares allocated, you're going to give it to your wealthiest client. Well, that wasn't me. Now it is because I've aggregated capital. So it does benefit me. I'm not doing it, like I said, for selfless purposes. It does benefit the investors because they get a free look, and if they don't want to invest, they don't, and if they do, and they don't get charged anything. So I think it's a win-win situation. It's worked out quite well for me.
What is your win? So I understand that like you also have an opportunity to participate in those deals. This is the major.
I get the economics we get. I mean, so if I could put in a couple $1 million per deal and I can aggregate $50 to $100 million of other people's capital, then we're in a different situation. So we can, if somebody's raising $100 million and we're putting in 50, we're going to get better economics. We're going to be part of the GP. I can't put in $50 million per deal. Now I can. So by aggregating everything, we get better economics in the deals, usually part of the GP. Sometimes we'll take a board seat, and it just benefits me. And like I said, we're typically the first call because we're very good about saying, if it's not a good fit, saying no quickly, which people do appreciate. And if it is a good deal, we've been able to aggregate $200 million in a period of that was kind of Herculean effort, but we can aggregate a lot of money in a very short period of time. So people know that if we like a deal, we'll come through.
Let's talk about numbers. So you already mentioned that like 100 plus trillion is going towards heirs in the next 20 years from boomers mainly. I heard that you say that if the amount of capital of a family office is less than 250 million, it doesn't make sense to launch a family office. So I want to understand, what do you think is the minimum size, and why this exact number is the minimum size?
It's a great question. You could reverse engineer it, and I could explain it to you. So 250 million is the minimum you need if you don't invest in direct deals. If you invest in the public markets, if you're going to have a direct deal team and you're going to invest directly and have people vet the private equity, venture capital, real estate, the minimum you need is about 500 million, and that's a bare bones minimum. The reason for this is family offices. If you do the math, if you reverse engineer it, if you look at the cost of you're having your own lawyer, your own admin, your own CIO, your own CFO, your own team to put it together, your own deal team, and you look at the costs of that, you really need about 500 million in order for it to make economic sense. If you have less than that, which is 300 million, still a lot of money, you're better off going to a multifamily office. And I think the trend is going to be a lot of these single family offices. Remember, this is a relatively new industry. I mean, 68% of the family offices that exist started since 2000, and half of those started since 2008, 2009 when the market turned. And it's not a question of that everybody wants to all of a sudden manage money. It was really a lack of trust of Wall Street. So it's not that all of these people want to be family offices. They just stopped trusting Wall Street and they'd rather do it themselves. So it's a really new industry, but it's also very fragmented. It's very siloed. It's very inefficient. The model doesn't work. Only 25% of families make it to the second generation. 10 make it to the third. 5 make it to the fourth. So you're dealing with people have a liquidity event. They want to get into a family office, but there's no playbook. And what I'm trying to do, I put together the Family Office Initiative at Stanford University, and I'm helping to put together the one at University of Chicago booth. And we're trying to basically professionalize the industry because it needs professionalization. What happens today is somebody has a liquidity event, they sell their company for $1 billion. 9 out of 10 times, the first thing they do is they start investing in some of their friends' deals. And that's really the last thing they should do. The first thing they should do is talk to an estate planning attorney and get the structure. It's like the foundation of a house. Once they do that, they should get the governance in place. Once they get the governance in place, they could have a mission statement. Once they do all of the softer skills, at that point, maybe 6 months or 12 months down the road, then they should start investing. But they do it backwards. And so we're trying to create sort of like a playbook on how to do this. And I think at Booth, we'll be able to do that. We'll be able to accomplish this.
What is the biggest family office you met, or like, is there a biggest family office existing?
Well, yeah, I mean, we work with families that are worth in excess of $30 billion. So we work with a lot of very large family offices.
But is there somewhere a list of family offices where like you can find, oh wow, this is some a family office, the biggest one in the world?
What's the biggest family office in the world? It's hard to say because some people have a quasi family office and they don't necessarily call it a family office and invest. So it's hard to say which one is there. And again, with family offices, it's not like you can go to PitchBook and you can find out all the information about venture capital firms and private equity firms. Families are private, so there's not a lot of data on them. And what I'm trying to solve for is, if only 25% of families make it to G2 and 10 make it to G3 and 5 make it to G4, it's fragmented, inefficient, and siloed. What can we do as an industry to change that? And today what happened is most of the people of liquidity events, they go to these family office conferences. And I'll keynote a lot of these conferences, and I'm friends with a lot of these people. They're very good people. But a lot of times the investors would ask me, I see you're keynoting this conference, should I go? And 9 out of 10 times I'll say no. It's not a good year. It's basically service providers pitching to service providers. It's a pay-to-play model. So I wanted to change that. I wanted to kind of pivot on that. So basically what I did at Stanford is I said, I want to put together a family office conference, but I want to put together one that not only that I would create, but that I would tell the investors that invest with me, yes, you should go to this one. So what I did is I went to Kirkland & Ellis. I went to Ryan Harris, who's the top guy at Kirkland for family offices. And I went to Bobby Silver, who's the top guy at EY. I said, look, you guys do the legwork. You guys put the conference together, and I'll do 2 things. I will get you world-class speakers, and I'll pick the content, because I know what families are looking to hear. They're not looking to be sold different deals. They're looking to be educated. So what we did, I'll give you 3 examples. First guy I called was Paul Carbone. Paul runs the family for Tony and JB Pritzker. Paul was talking about due diligence. He was just basically saying, at Pritzker, we start with 1,000 companies, then it goes to 500, then 250, and then I come on board. And they just talk about the funnel of how they do due diligence. They weren't raising money for a fund. They weren't raising any money. They were just educating people on how they do due diligence. That's it. Second example is Tim Callahan, who is Sam Zell's partner. Tim, this is during COVID. And again, during COVID, people didn't know if people would ever come back to offices or what was going to happen. Tim was one of the top people in the country in investing in offices. And he wasn't raising Fund 4 or Fund 3. He wasn't raising any money. He was simply opining on what he thought was going to happen to the family, to the office market, because he's a thought leader in the space. Not selling anything, just giving his opinion. And it turned out he was spot on. Last example is Denise Illich, who's a good friend. Denise, they own Little Caesars, and they own a couple sports teams in Detroit. She, along with Dan Gilbert, really helped rebuild Detroit. And she wasn't at the conference trying to convince people or ask people to donate to her charity. She was just saying, look, if you're going to be philanthropic, and I don't care what the cause is, you have to run it more like a business. Here's kind of what we did right. Here's what we did wrong, but here's what we got right. And so she was basically educating people, giving people a playbook on, it doesn't matter if it's poverty, if it's autism, if it whatever the cause is. She's saying if you're going to be philanthropic, run it more like a business. We had 880 families from 6 continents on a Zoom call during COVID, 420 over $1 billion, which is about tenfold what Kirkland and EY had expected. So that was basically the check the box. Yeah, there's a huge demand for this. And the beauty of it, we didn't have to make money. This was not a for-profit thing. They just wanted to cover their costs. So we scaled that, and then at Stanford, then John Doerr donated $1.5 billion for the school sustainability, and I didn't. And 3 years ago, I was having lunch with Michael Milken, who was my first boss, and Steve Kaplan, who's the top professor at Booth. And I just said, I want to take what I've created and kind of move it over to Booth. And before I finished the sentence, Steve said, I'd love to do something like that. And Paul Carbone, who's also a good friend of his, is also looking to do it. So the three of us really got together and put this thing together. So what we did is we put together we actually had a class. You have to be an MBA student at Booth. And we had a class. We thought it would do well, but this is an experiment at the time. It sold out right away. We had 65 students. You had to be an MBA student at Booth. The reviews were phenomenal. We had Professor Heaton teach the course. I taught one of the courses, but Professor Heaton was the main teacher. And we basically educated these students about family offices. And now it got so popular that we're going to have a full credit class going forward for next semester. And then we're putting together a conference similar to what I put together at Stanford. But again, we don't have to make money. This is by partnering with the university. What's their agenda? They've got their agenda is research and education. That's what their agenda is. And that's fine. They might want to have a rich guy donate a building. The alignment of interest and their agenda. So if we don't have to focus on making money for the conference, we could just educate people. So at the conference, we're going to have people we'll have Nobel Prize winners talking about macroeconomics and the economy and just geopolitical things that are happening in the world, and just educate. And, it'll happen in May. It's limited. It's, we've gotten thousands of requests. We're only going to limit it to about 150 people because we want to keep it small and intimate. But I think this is going to change. And once I announce this, MIT reached out to me, and there's about a dozen other schools that reached out. So I think while this is the first, it certainly won't be the last. And I think going forward, the playbook is going to be a lot of the learning going forward for these family offices once they have a liquidity event is not going to happen at a family office conference like they currently do. It's going to happen at the university level. And that's what I'm excited about.
I heard many numbers about how many family offices exist today. 8,000, 10,000, 15, 17. Also, there was statistic that in the world there are 69,000 of rich people who are over 50 million in assets. What is your current number, or what data you rely on about how many family offices?
It's a great question. I mean, the honest answer is I don't know. Because people say there's no statistics for it, and people could say, yes, I've got a family office, so they put down, okay, this person has a family office. But when I look at a family office, I say, okay, in order to have a family office, 250 million is a bare bones minimum. 500 if you're going to invest in the direct deals. I'd say it's closer to 5 to 10,000 would be the number, but that's an educated guess.
What is the number of capitals they manage, total?
So that's fairly well known. So there's roughly $10 trillion in capital. So to put it in perspective, there's $10 trillion in capital managed by family offices. There's 6.5 trillion globally in the entire hedge fund universe. So the market for just family offices is larger than the entire hedge fund market. But over the next 20 years, where we've got 124 trillion that's being transferred from the baby boomers to the next gen, this market will soon be bigger than private equity and venture capital combined. So this is going to be massive. And what we need to do is we need to get it right. We need to professionalize it. We need to get playbooks. We need to figure out ways to compensate the people. And we're maybe in this. I used to think we were in the third inning. Now I kind of think we're in the second inning in the evolution. And I think how it's going to play out is that as private equity and venture capital disrupted the public markets in the late 80s because it was a better model, I think family offices are going to not replace, but they're going to start to disrupt private equity and venture capital because a lot of those firms have become an AUM game, and the model, I think, there's an inherent conflict.
How these rich people will pass down their wealth? I mean, if not through family offices. So is there a legal structure that is more, I know you use a term of structural alpha, and maybe, do you think that it's more effective to put it through family offices? Or if not through family offices, how is it typically done to minimize taxes and optimize the structure?
So that's a great question. And it really depends. It's dependent on each person. So if you sell your company and you've worked 30, 40, 50 years and you're really burnt out and tired and you just kind of want to just take it easy right now, don't start a family office because you're better off going to a multifamily office, even if you're worth billions. Because unless you run this full time like a business, you shouldn't do it because you'll get clobbered. I mean, a lot of these family offices that exist shouldn't exist and should be morphed into multifamily offices. So the answer to your question is, if you're willing to commit the time, effort, and money and bandwidth, you've got the bandwidth to do this full time, yeah, a family office is the best way to do it. If you don't, go to a multifamily office. And I think that's where the growth is going to be.
What typical structures are? So do you want to cover a bit about legal structures? I mean, are those trusts or some other ways of putting a family office?
Well, family offices, what was interesting is when I ran my hedge fund in the 90s, I was trying to raise $10 million from this. They used to call them rich people. Now they call them family offices. So this rich guy, he had his estate planning attorney in the room. And he was asking me strategic, like how I invest. I had no clue why the estate planning attorney was there because he didn't understand. He's a brilliant guy, but he didn't understand the investing side. And so afterwards, I said to him, nicely, politely, so why was he in the room and not your CIO? And he kind of patted me on the back. He said, you'll learn. He goes, the goal is not to be worth $1 billion or $10 billion. The goal is to be worth zero, but control as much as you can. And all these T&E attorneys do is get things out of your estate. So if somebody's out of the Forbes 400, it's not that they had a bad year. They probably did good estate planning. So I learned the importance of working with an estate planning attorney. And I think that's probably the single most valuable person that these family offices work for. It's not the CIO. It's not the person who finds deals. It's working with the estate planning attorneys to help them structure things to get them out of their estate. And again, if you do enough planning and you do it thoughtfully, the goal is to be worth close to zero, control as much as you can. And, so then you're legally protected, your asset protected, you can't be sued, and you've done everything you can. So that's really the ultimate goal, but it takes decades in order to do that properly.
Wes, I know there is not so much data. The same, actually, when you talk about family offices, it reminds me how I talk about venture studios that, yes, we try to create some data on the topic, but it's still very nascent field. And the same question is about returns, or whether there are some indicators that being a family office and investing directly is more efficient than just investing as a limited partner in venture funds, private equity funds. I know your example about private equity funds that need to sell their assets every, let's say, 5 years in order to return money to LPs. The same company is going from one private equity firm to another several times during those 20-year period, and the family office can hold it for 20 plus years, having a patient capital. But is there any indicator of being a more effective investment instrument than some other forms, whether family offices will outperform some, for example, S&P 500?
That's an excellent question. And what's interesting is most of these family offices, even though we do direct deals, but we've got access to the top people in the country, most of these family offices do not have the infrastructure or the bandwidth or the bench strength to do direct deals. And yet they still do them. And so what happened was post-crash, pre-COVID, I don't care what you invested in, you probably made money. Private, interest rates were zero. It wasn't challenging to make money in real estate. Venture capital went up, private equity went up, invest in Bitcoin, the stock market went up, everything went up. So what families started to do is they said, well, why should I pay an expert 2 and 20 if I can make money and pay them nothing? And they were right until they were wrong. And what happened was about 3 years ago when the Fed started jacking up interest rates, now these deals, which seemed so easy, now families were not only not making money, they were actually losing money. So you have a huge group of, and I think the backlash is going to be that a lot of these families that did the direct deals post-crash, pre-COVID, who didn't have the bench strength, which is the vast majority of them, are going to now go back into multifamily offices. If they made their money in real estate, they'll focus on real estate and they'll outsource the rest. If they made their money in technology, they'll focus on tech and outsource the rest. And I think you're going to see that. So what happened was you had everyone was going direct because they didn't want to pay the fees, and it made sense until it didn't make sense. Now, having said that, even though very few family offices can execute, I think more and more will be able to. So if you look at the Pritzkers, the Crowns, the Gates, Ballmer, Dell, DeVos, the large family offices, they have something called patient capital. And patient capital is the single biggest advantage family offices have. So as I'd mentioned before in my last interview I did with David Rubenstein, what happens is the way the model works today, a private equity firm is going to buy a company, let's say a garage door company in Des Moines, Iowa. When they buy it, I could tell you about when they're going to sell it because I know how they're compensated. It doesn't make them bad people. It's just they're compensated to flip companies every 5 years. So they're going to buy it, hold it for 5 years. That private equity firm is then, they could sell it to strategic, but oftentimes it's to a second private equity firm. And I could tell you how long they're going to hold it. It's approximately 5 years because I know the alignment of interest. I know how they're compensated. So if you look at the course over 20 years, you could see one company change hands let's call it 4 times. If you look at the taxes and the friction and the disruption in business versus a family office who has something called patient capital and can simply buy it, hold it, and let it compound, the results aren't even close. The problem is very few families can execute like that. More and more will. It is objectively a superior model if you have the right team in place. And there aren't a lot of family offices that have the right team in place. My belief is that in the next 5 to 10 years, you'll see that. I think we're at an inflection point, and families are tired of these private equity firms. It's become an AUM game. I had a close friend who did a roll-up of logistics companies. He had a phenomenal track record. He needed $150 million, and the placement agent, based on his track record, was able to get him $500 million. And my friend said, well, we just need 150 to get started. The placement agent literally came to his house in New York and wrote down 2% of 500 equals X, 2% of 150 equals Y. What am I missing? And what my friend said, who was a bit incredulous, is if I do what you want me to do, there won't be a fund 2. Because yes, I'm smart enough to know that I personally can make more money if I manage 500 million than 150 million, because 2% of 500 million is more. But I can't deploy the other $350 million. To me, that's a microcosm of what's wrong with the industry. It's become an AUM game. Not all, but many of them. And in order to create true alpha, in my opinion, you really need to operate. I could financially engineer a company and make money and flip it and make money for the investor short term. But for the long-term best interest of a company, you need to operate. And if you look at a lot of the private equity and venture capital people now, and I'm a finance guy too, they're mostly finance people. In order to create alpha, you need to operate, not financially engineer. And I think that's going to change.
So you think more operators will be in there? So those family offices that, let's say 500 plus million, they will have more operators in their team if they want to invest directly in private equity. So just financial expertise will not be enough. And they will need to also be...
To create true alpha, you really do need to operate. I mean, I could financially engineer something. I could leverage something and cut a whole bunch of costs. And there's ways to do it. So short term, it's not challenging to make money. But if you're looking at the long-term interest of the company, what's best for the company, a family office, if they have the infrastructure in place, is going to be more and more important. So right now, before family offices came into the equation, if you had a company and you're looking to sell, you really only had two options. You could either sell to a strategic, and oftentimes that strategic is a competitor in your industry, and maybe you don't have the best relationship with them, you compete with them, or you sell to a private equity firm. And the private equity firm, their goal is to make money for their investors, which is what they're supposed to do. But the goal really, they don't look at it through the lens of how can I make this company the most profitable company in 20 years. So if you have a company and you're looking to sell it and you're looking to sell it to the highest bidder, it'll never be a family office. It'll always be a private equity firm, because they raise so much money and they've got two options. They could either deploy the cash, which they'll do 100% of the time and sometimes overpay for companies, or B, they could return the money to the investors, which as far as I know, they've done 0.0% of the time. So that being the case, if they've raised all of this money, and we saw it in 2018, 2019, they were sitting on so much cash. We were going to buy companies with some families, and then all of a sudden, the private equity firm paid twice what we were willing to pay. And it's a great company, but there's no way it's worth that much money. But they had to do it because they had the capital and they had so much capital. So I think there's a fundamental shift that's going to take place. It comes back to alignment of interest. But we're still very, very early, because family offices right now, even though what I'm saying conceptually is correct, very few families can execute. So it is objectively a better model, but if people can't execute, you're still better off going to the big private equity firms. I think we're at an inflection point, and I think over the next 5 to 10 years, you're going to see more and more of these families become sophisticated and be able to compete directly with the KKRs, the Apollos, the Carlyles of the world. And many people, if you're going to sell your company and you care about G2 or G3 or the employees, or you want it to be in existence for 50 years, the family office is really going to be the first choice they're going to look, not the second or third.
So if I understood correctly, buyers will choose them just because they can offer more capital. But whether there are some advantages of having a family office as a buyer. So if an investor, it's maybe easier because it's a patient capital. Maybe sometimes it's even easier for a family office to make a decision so that there is less potentially due diligence. At least this is how I perceive the markets. So that VCs and private equity fund managers and venture studios, they want to fundraise from family offices because they don't have a strict mandate on investing, and there's someone who can invest in them as LPs, of course. But as a company, I see also some companies on Series A plus, they also consider family offices as one of the main source of capital for them. And maybe because either it's my perception or not that family offices can invest more easily. Maybe of course because they don't have such sophisticated teams and they don't do such a strict due diligence. My initial question was here that if private equity firms are ready to pay more, whether family offices finally will be able to buy companies also effectively and keep them. What do you think about being a competitive investor?
So right now today we're very early, right? Let's say we're in the second inning. Very few family offices can, even though their model is objectively superior because they've got patient capital and there's no artificial time clock to sell a company, you're still in most instances, you're still better off going to a private equity firm because most family offices can't execute. So if you have now I think that's going to change. And if you have a company that that's been in your family for 2 or 3 generations and you're looking to sell it at the highest price, today it's going to always go to a private equity firm because they're going to give you, if your goal is just to cash out and make the most money without repercussions of what happens 10, 20, 50 years down the road. If you want to take the company and say in 20, 30, 40, 50 years, you want the company to grow like this, if you have the right team in place, which most don't, but more will go to the family office model. So Paul Carbone, who runs the family office for Tony Pritzker and JB Pritzker, he's got a competitive advantage over KKR and Apollo. He's not going to they might pay more for a company because they have the cash that they have to use, but he's got patient capital. They've got patient capital. And that's just one example of somebody that's sophisticated. I just think you're going to see more and more of these families become more sophisticated. I mean, one of the things we have to get right is the compensation model. Right now, the compensation model for family offices is, and again, I'm generalizing, most family offices, if they hire a kid out of Stanford MBA program or Wharton and pay him $500,000 a year, they look at that as a cost. I can promise you if Carlyle or Blackstone pays somebody out of Stanford or Wharton $500,000 a year, they don't look at that as a cost. They look at that as a potential $20 million profit center. So it's nuanced, right? But once families have to get the compensation model right. In order to do that, you have to give them not just a good salary, you have to give them part of the carry. You have to give them lines of credit or loans that they could take because they want to get wealthy as well. And the smart firms have done that, but the compensation model is something that family offices currently do not have a grip on. That's something we're trying to change. And I think once they change that, more and more talent will come into the family offices. And then you can compete directly. Right now, you just don't have, in general, you don't have as much talent in the family offices as you do the private equity or venture capital firms. So it's hard to compete. But again, we're at an inflection point. And I think if we have this conversation in 5 to 10 years, it's going to be a completely different conversation. But what's exciting is that my world is changing in real time.
Do you think that for buyout, private equity will pay more, but when investing, let's say it's not a full buyout, but it's less acquisition of 50% or 75% or 25%, then family offices, they can be more effective because it's patient capital, and because if there are good operators, then it will be more effective. I'm just trying to put a puzzle in my head about in what type of cases family offices might be more efficient, and where the advantage of patient capital might be applied in private equity.
The advantage of patient capital for family office if you're going to sell your company, right, and you've got children or grandchildren or people who've worked with you who are your friends for 20 years, and you're not looking to make the most money in today, but you're looking out to make the most money in 20 years, right? The family office model is a better model if you have the right team, because the other company, they already have a debt. They buy the company. They already have a shot clock. They know in 5 years they have to sell it. Now, 5 years might be a great time to sell it. It also might be a terrible time to sell it. And even if it's a terrible time to sell it, they're still going to probably sell it because they have to they have to recycle that money. So I just think that, it's going to come down to alignment of interest. But, today you've got huge amount of capital in very inefficient hands. I mean, just because, Ty Warner sold Beanie Babies and he was a brilliant businessman for billions of dollars doesn't mean he has the capacity to buy the Four Seasons Hotel, which was a debacle. And so I think what happens is the ego of a lot of these founders is probably the biggest competitor that many of them have, because I'm good at a couple things. I'm really bad at a lot of stuff. And I think that's true with most people. But once you have a liquidity event and everyone's giving you a high five and telling you how great you are and you start believing it, well, I can't invest in venture like you. I mean, that's what you do. I don't. I can't invest in real estate like Tim Callahan. That's all he does. I can't invest in private equity like Paul Carbone. That's his baby. So you basically have to surround yourself. You have to take your ego out of the equation and surround yourself with smarter people. And that's basically what we've done.
And the model here, so the simple answer to the question whether family offices should invest as LPs or invest directly. So if they are experts in specific fields, they can do direct, but if they want just to diversify their portfolio with other instruments, it's better always to find those top 1%.
Today, the way most family offices are structured and the people they have on their team, they're going to be mostly better off investing in funds and not investing directly, because they don't have the infrastructure to compete directly with the Carlyles. Those that do have a superior model. What I think is going to happen is you're going to see more and more of those firms that have the infrastructure to be able to do it. But today, if you ask me right now, most family offices should be investing in funds, should not be investing directly because they don't have the bench strength to do it. And a lot of them do it because they're myopic and they want to save money on fees. That's not the reason to invest. If you have a problem with your heart, you're not going to go to a doctor because he's a little bit cheaper. You're going to go to the doctor because he's the best doctor in the world. That's kind of the analogy I use.
What is the average team size of a family office and the compensation? For example, Wikipedia says that a family office can cost over 1 million a year to operate, and this is why they should be like minimum 50, 100 million, in your opinion, 250 or even 500 plus. But what is the typical size now? What do you see in a family office? Like whether there are 5 people, 10 people, whether there is like 1 million a year operation costs or some other figures?
That's a great question. It really depends. I mean, the main question is, are you going to invest direct or are you just going to invest in funds? And also, are you going to invest in the private markets or the public markets? If you're going to invest just in the public market, in the stock market and the bond market, and you're not going to do direct deals, you really don't need a huge team, period. But if you're going to invest in the private markets and you're going to invest directly, you need a deal team. And you need a CIO, a CEO, a CFO, a deal team, admin, accountants, lawyer. You need a full staff to do that. And if you do the math and reverse engineer it, unless you have about $500 million and you're going to do direct deals in the private markets, you're going to almost always be better off in a multifamily office. The reason that they don't go to a multifamily office, in my opinion, is A, they don't know any better to start. B, the ego. They want to have it's a thing right now. I own a family. I have a family office. Well, how about not having a family office and doing better? There's a lot of psychology behind it, right? And I think that you're going to change this, but this industry is changing in real time. And what we're creating at Booth is we're trying to create a playbook for it for the family office to say, okay, in order to start a family office, you need X. Okay, 250 million if you're going to invest in the public markets, a minimum of 500 million if you're going to invest in the private markets and do direct deals. In order to do that, the first thing you should do is talk to an estate planning attorney. Then you should get your governance set up. Then you should do that. So we're trying to create a playbook, and right now there is no playbook. And remember, this is a new industry because it's been around for generations, but in the US, 68% started in 2000. That's a new industry. And all you have to do is look at the numbers. 25% make it to the second gen, 10 make it to the third, 5 make it to the fourth. The model does not work.
Actually, what differentiates those 5% or those 10% or 25%?
What differentiates them a lot of times is the matriarch or patriarch will suppress their ego and surround themselves with smarter people and really listen. You got 2 ears and 1 mouth, and a lot of people want to talk more than they listen. It's better to listen and learn from other people. And I think that there's a lot of mistakes that family offices made and will continue to make. But I think that the family offices that make it to the 5th, 6th, 7th, 8th generation, they started with structure. They started with a estate planning attorney. They started with governance. They started with a mission statement. They didn't start with investments. And I think that's one of the differentiators. And if you get that playbook right, and that's what we're trying to create for the family office market, because remember, this is a new industry. This is a new way that companies are going to be financed going forward. So we are at a fascinating point in history. We're literally at 1987 when private equity and venture capital disrupted the public markets. I run a hedge fund. You invest in my hedge. If you're an investor, as a hedge fund, you've got to report every 90 days if you're investing in the public markets. That's not necessarily the best model. So private equity and venture capital took off because they didn't have to report earnings every 90 days. They're just going to grow their company as they see fit to grow their company long term. And 2% covered the overhead. 20%, I make money if you make money. It was a better model. But what happened was it did ultimately, not completely, but in many instances become an AUM game. Because the private equity firms realized if I can make, my example with my friend who did the 150 or 500 million is an example, but if I could raise $5 billion and I'm making 2% on $5 billion as an annuity every single year, in order to create true alpha, it should be $500 million where the investors will do better. The GPs are going to do better financially by having more money. And I think that's an inherent conflict of interest. So it's become an AUM game. Not always, but in many instances. I think that's starting to change. And as families become more sophisticated and they start learning that, the goal is not to invest in a KKR fund that's $25 billion. True alpha is created with the funds that are anywhere between $100 million to $1 billion. And those are the funds really where you can create that alpha. And I think more and more firms will realize it. So we're at like I said, at an inflection point, and there's been a lot of learnings over the next 5 to 10 years. A lot of universities like what we're doing at Booth are going to emulate what we're doing, and you're going to see more of a playbook, and you're going to see a lot of these family offices become more professionalized and more institutionalized. Right now, they're not.
The last question about numbers. So it's only one block of information about numbers, but do you have in mind some of the distribution of the portfolio allocation of a family office? So whether real estate is like the biggest, or private equity is the biggest, or public markets, like what is current? How do you see family offices approach their portfolio construction?
Well, the number of public companies is going down, and the number of private companies is going up, and that's a trend that's going to continue. And part of the reason for that is that a lot of the alpha is created when the company's private, right? So it's not after they go public, then there's alpha created. A lot of the alpha is created, and companies are staying private longer, right? So a lot of the family offices, the two biggest asset classes by far are real estate and private equity in the family office space. They're the two most lucrative. It represents almost half of what they're investing in. Venture is an incredible asset class if that's all you do. If you don't only do venture, you shouldn't touch it. And you should outsource it to somebody like you or somebody who's an expert in venture. And I see a lot of people see these direct deals. They see these shiny objects. They see this could potentially be 100 times 500, whatever it is. I mean, look, the model for the venture capital firms, the early stage companies, is the top venture capital people, which is all they do. If they're going to invest in 10 companies that are early stage, they assume 6 are going to go to zero. Okay. 2 or 3, maybe singles or doubles, and 1 home run gives you 3x for the fund. Well, if the top people in the world who do this are saying 6 out of 10 go to zero, why would you invest? Why would you invest in that if that's not what you do? So I just think a lot of it's commonsensical. Again, venture is a great asset class if you know what you're doing. But again, there aren't a lot of people who are experts in venture.
What is the difference between a single family office and a multifamily office? And those multifamily offices, like what is their origin? Are they usually started by some like advisory firms or consultants that just want to attract more and more, or like half of them are started by actually family offices, rich people that did well with their own wealth and then started to attract others? So how you can compare and explain the difference of both models?
Initially, 20 years ago, you had the wirehouses. You had, all the Merrill Lynches of the world, and they're technically not even fiduciaries, which is really head scratching when you think about it. And what happened about 20 years ago is RIAs, registered investment advisors, became more and more important. Now, RIA it's a better alignment of interest. They're fiduciaries, right? And they're paid on performance. So the RIAs really took off. So a lot of the large wirehouses, the top people left them and became RIAs, and then it's just basically a structure. So basically, they're a fiduciary. So they have an alliance. So it's a better model than the wirehouses. But then on top of that, a lot of these RIAs, which are trying to create alpha and make money for you, they went one step further in the multifamily office market. And the difference is so a lot of the multifamily offices came from the RIAs, and basically it's doing what an RIA does, but looking at things holistically. So adding things like estate planning, wealth transfer, family governance, things like that. And so it's not necessarily, they look at the whole picture. It's not necessarily that you want to create the most alpha, because part of what you might be doing is trying to get money out of your estate. Your kid might want to start a business. You might want to invest with them. So the difference from the multifamily offices to the RIAs is the multifamily offices look at things holistically. The RIAs in general look at things more, how can we make as much profit as possible? And I think the trend is going to be more and more of these RIAs are going to look to become multifamily offices because that's where all the money is.
Do you have any ideas of how many such multifamily offices and like of how many families they typically construct, and how does it work? Because I met different types of multifamily offices, and they sometimes show that they are quite huge and they manage huge capital, but I just don't understand whether some of them invest the whole capital or like manage the whole capital of a family, or they just get like, let's say 20% of someone's capital and they manage it. So if you can dive deep
It's all over the place. A lot of families aren't going to give 100% of their assets to a multifamily office. They might give 20, 30, 40% of their assets. Some will give it all, but most won't give all of it to it. And some of them will put their money, which is not a good model, they'll go to 2 or 3 different MFOs or 2 to 3 different RIAs. So the thought process being we're diversifying. Well, that's actually a bad model, because what happens is, what if all 3 RIAs think you should invest in Apple? Well, then you're overweighted in Apple, right? So the goal is really to pick the right RIA or the right multifamily office, one, not 2 or 3, because they're not talking to each other. And because if you're picking 3 and all of these companies love a lot of these FANG stocks, you're going to be ridiculously overweighted in FANG stocks, because RA1 is not talking to RA2, which is not talking to RA3, and many of them are doing the same things, and as a result, your portfolio is way overweighted. So the best model is to find the people that you trust implicitly, find one firm, RA, multifamily office, that you want to work with. And I would base that on relationships. A lot of, a multifamily office is not going to make you rich. People are going to get rich by being entrepreneurs, by doing what they do. The goal of a multifamily office is simply to beat a benchmark by 100, 200 bips and give consulting to the family, not to double or triple your money. So I think a lot of people have to go into the mindset of, I'm going to make my money doing what I do. I'm great in real estate, or I'm great in venture, or I'm great in private equity, or I'm great in this area. That's where they're going to make their wealth. But then they're going to invest in a multifamily office, and they shouldn't expect to double they'll never do as well as they do as entrepreneurs. Their goal is just to beat a benchmark and to work with somebody they trust implicitly, and to make their life much simpler, because simplicity, the older and the wealthier you get, the more simplicity you're looking for.
You already talked about your syndicate. If you can dive deep a bit, so you said that you're doing about 10 deals a year, and those deals, like you benefit, if I understood, mainly from the opportunity to participate in bigger deals and to also have interest. So like when you are a small check in a big round, so you cannot control anything, but if you're a big check, maybe you can negotiate a board seat or some additional benefits. Can you explain like what is typical deal flow? So you have many family offices, you have a huge network. How do you get deals? And then so when you understood that this deal is great to invest in and you want to attract, what is the process? So you just like know the best 20 family offices to call and to invite to this deal, and you just like call, send them the investment memo or something, and what is yours? So if you can explain, would be interesting.
I understand. It's a good question. A lot of times it's actually flipped from what you're saying. So a lot of the deals we get come directly from families. So a large family office might be take down $200 million of a deal, and there's 250 million. Then they'll show us, and we'll take the other 50, right? So a lot of the deals that we get actually come from the largest and most sophisticated family offices who've got huge teams that vet it. They vetted it. They're already putting in a huge chunk of money. They need to round it out. And $50 million, that's a good number for us to round it out. So a lot of them, most of the deals we get come directly from the family offices that are investing but don't want to invest in the entire capital stack.
Okay, and you think that it's better, like for you, for your mission, it's better to not take any commissions, but create like more trust in long term?
Well, it's a fundamental question. So personally, I can make more money if I charged a fee short term. What I'm doing doesn't make sense from a short term standpoint because I'm not charging anything. My belief is I look at things not how it's going to impact me in a year or 2 years, but 10 and 20 years. And I think because I'm completely aligned with these people, I have opportunities that I'm not going to get otherwise. And because I have these opportunities, while I'm not making money per deal, I'm taking the capital that I have and deploying it in a way that I wouldn't otherwise be able to deploy it. And so I'm taking my capital and creating better deal, getting better deals. So I call it first call alpha. If a business school looked at what I did, they would say, well, this isn't a business model. And they're technically correct. But I think medium and long term, if I'm aligning myself with all of these people and they're going to show me these deals, I will make more money on my own capital than I will by charging fees. And that's just the route I've chosen to go. Most people don't do what I'm doing, but it's the route I've chosen to go, and it's worked out quite well.
Yeah, because earlier I met also some like family office clubs that are interested in attracting more family offices, and their model is to charge fees. And of course, like the more family offices you have in your community, bigger deals you can do, more you can earn. And this is
the value proposition for the family office working with us in a syndicate is we'll give you access to incredible deals that we get from the top family offices. If you want to come in, great. If you don't, that's fine too. And you don't pay any fees on top of it. So it's a good model for them, but it also benefits me.
Yeah. Okay, understood. Now let's talk about, you know that many GPs of VC funds, private equity funds, they fundraise from family offices and they always want to be in front of family offices. But I'd like to ask you, so of course you need to provide value to those family offices first. And the value might be in terms of deal flow, your expertise, or maybe content creation might be a good way to start. But what are some inobvious ways to get in front of family offices or attract their attention in order to be useful for them?
I have an accountant. His name is Saul, and he's a great accountant. He didn't go to the best school, and there might be people who have better degrees than him, and maybe even know a couple things that he doesn't know. I don't know, but he's really, really good. But the reason that I stay with him is because when I'm close to the tax deadline and I get a call from him, he's more stressed out than I am. I have to calm him down. That's somebody that I want to work with. And from a family office standpoint, what people don't understand is that institutions, when they look to make an investment, the first, second, third thing they're going to look at is what's your 1, 3, 5-year track record, what's your biggest drawdown, all the statistics. And then they'll do a little diligence on you as a person. It's flipped for a family. The first, second, third thing a family wants to know is, can they trust you? Do you have their back? Are you a good person, and will you always work in their best interest? Once they establish that, then they're going to say, okay, what's your track record, what's your school, what's your background, et cetera. So it's flipped. So the main thing is that a lot of the family offices, they want to work with somebody that they know they can trust, and that's just something that's earned. It's not, they would rather work with somebody they trust implicitly, that's really good, versus somebody they kind of trust but has an incredible track record. They would almost always work with the first person rather than the second.
Are there some ideas on if someone now don't have any connections with family offices, but they want to, and they have, let's say, they build a strategy that in the next 5 years they will become like well connected with family offices. What might be your advice for such people?
It's a great question, and I'm asked it a lot. It's very hard because right now there is no. I can't. You can go to PitchBook, and I could look up the top 100 private equity firms. I could look up the top 100 venture capital firms. You can't do that with family offices because they're private, and it's really incumbent upon us, upon the family offices, to change that. Because right now, how do the smart people find the rich people, and how do the rich people find the smart people? They really don't. It's a one-off thing. I think how this is going to play out is if these family offices want to compete with the Carlyles, Blackstone, KKRs of the world, they're going to have to let people know what, yes, we invest in early stage venture. We don't invest in real estate. We invest in private equity, but only in these three verticals. So it's incumbent on family offices to let them know, because if they don't know, then let's say you're a young kid graduated from Stanford and you've got a great technology, and and there's a family office that also likes to invest in early stage companies, and the match would be great. But again, the smart guy doesn't know about the rich guy, and the rich guy doesn't know about the smart guy. How do you do that? I think that we're going to have to put together area groups, and it's going to be incumbent on the family offices to let the investors know, here's what we're looking for, here's what we do, here's our average size check. We do need a board seat, or we don't need a board seat. We want minority, we want majority, whatever it is. They have to explain it to them, and then the entrepreneur will know who to go to. But right now, it's a completely inefficient system, and again, that's something we're trying to change as well.
I thought about different ways on how to connect. How would I solve this situation? I had such ideas like different random ideas. LinkedIn email outreach mostly don't work if it's just cold outreach and fundraising or something. Some people, they host dinners or events or some parties. And maybe if you attract some celebrity or some politician or some very rich people, so if you have one, it might be a good magnet to attract others. Do you think it's a good idea, like to organize some dinners or parties in order to invite more family offices there?
It's really going to depend, and it's got to know what's your bandwidth and what's your reach. I mean, it really depends. So it's going to be different. It's going to be different in every situation.
Your thought about this is to create some sort of platform to have information about family offices and what they invest, what they are looking, and let others side of a marketplace to learn and make meaningful connection, not just spam.
In an ideal world, the family offices that want to compete directly with the large firms, that have the bandwidth and the compensation right, they will, on a piece of paper, say, I invest in these 4 verticals. My average size check is this. Here's what we require. I'm industry agnostic, or I like these industries. And they're going to write down on 1 or 2 pages what they look for. That way, when you're looking to raise the money, the person who's looking to raise the money, if they see, well, they don't invest in early stage venture, and your early stage venture, it would be a waste of time to call them. So that's what families have to get right now. So a lot of it's incumbent upon us, not on the entrepreneur.
Okay, understood. Then you emphasize the importance of values first approach and values first investments of family offices in comparison with just other types of investment firms. How this knowledge can be used when approaching family offices? So I think that it's important to understand motivations and whether such ideal platform would include their like mission or their what they treat, or like what they are looking for in entrepreneurs or something. Founders raise from VCs and sometimes from PEs or some other firms, and it's different to raise from a family office because they not think only about returns, but also think about their mission or about some impact, and how this knowledge can be used to help entrepreneurs or funds to raise from family office.
Well, again, it has to do with what I said, that family offices have to let the entrepreneurs know, this is what we do, these are our values, these are our missions, these are the investments we look at, and give them all the statistics. Because without that information, if you're going to invest, if you're an investor and you're investing in an oil field, and the family office is only investing in, impact investing and things that, save the environment, it's a waste of time. So you basically want to get, and it's going to take a while to do this. I mean, this is a 10 to 20 year fundamental shift. So it's very equivalent to the late 80s when private equity and venture capital disrupted the public markets. We're super early in this, right? And there's a whole bunch of things that have to change, but a lot of it's incumbent upon the family offices, not necessarily the entrepreneurs.
Mm-hmm. Okay, my last part of the interview is about top three things. So let's start with top three family office trends you see now.
I think for trends, I think that more and more family offices are starting to listen more and not necessarily go to the conferences. I think one of the trends is going to be what we're creating at Booth, where a trend is going to be these family office, the conferences are going to come from the university level. I think that's one trend. I think the second trend is family offices are starting to become more professional and institutionalized. And I think the third trend is family offices are really focusing on running their philanthropies, whatever their philanthropic endeavors are, more like a business. So those are the three major trends that I see.
Mm-hmm. What is the three challenges in the family office world?
There's huge challenges in the family office world. Again, it's inefficient, fragmented, siloed. The numbers don't work. 25% make it to G2, 10 to G3, 5 to G4. So there's a whole bunch that would take too long. There's a whole bunch that family offices need to get right. And I don't think that there's three top ones. I just think that they have to let people know what they're investing in. They have to let people know what they're looking to do. They have to professionalize their staff. They have to have mission statements. They have to have governance, and those are the things that the family office have to get right. And most of them don't.
If you would name top three experts in family offices, who would you name?
Well, there's different experts in different things. I mean, for governance, there's a guy named Richard Wolkowitz, who I think is a top expert in the country just for governance. There's a guy, Patrick McCurry, who I think is a top expert in income tax planning, specifically for family offices. There's a woman, Karen Yanis, I think is best in class in helping family offices in philanthropy. She used to do Oprah Winfrey's philanthropy and then the Crown family. So those are the three.
Thank you, Ron.
Okay, thank you. It's been a pleasure.